Hello guys, welcome back to the channel, best place for long-term stock investors. Today we will be talking about tech, essentially global and also local. It's been making a comeback, and so the question is whether or not it is sustainable or is it a dead cat bounce. Now before we begin, none of this should be financial advice. Please speak to a pro if you want that sort of advice, and we do own some shares mentioned in this video. Alright guys, if you're interested in building a six-figure portfolio using stock investing and smart money tips starting from absolute zero, you can check out our free guidebook, which you can download in the comments or the description. Okay, so what's up, right? What is actually happening in the market? Some of you who are following the markets will probably know, but let's say if you don't, I'll just give you a brief rundown. So the Nasdaq essentially is down nearly 22% a year to date. But since around the start of June, it's up 16%. And so the question is this a sign of recovery? Now, when you look at the Malaysia Tech Index, it's actually down a lot more, right? Negative 32% year to date. And also in the middle of June up to the time of this recording, which is the 1st of August, you are looking at also a 16% climb. And so it's very interesting. A lot of people are asking us, what do we think? Is this going to be the beginning of a bull run, or is just a chance for profit taking because, you know, tech might fall down further? So as you know, we always like to look at the data. So specifically for this bounce, a lot of it has to do with people's slightly changing expectations, right, of what the Federal Reserve could do. It's up, you know, it jumps 4% because they think the rate hikes will actually start to slow down. For those of you who didn't know, rate hikes tend to have an effect on high growth technology stocks because these are the so-called riskiest ones. And when the risk-free rate, which is the Fed's funds rate, go up, then it becomes more attractive to hold cash, and the first group of securities or stocks to be, let's say, liquidated will be tech stocks, generally speaking. So when rate hikes are expected to slow down, you would expect tech to rebound, so to speak. So one thing we have to ask ourselves is, where is the Federal Reserve funds rate going? Now, my opinion is that the hike seems to be really fast. And if you look at 2000, just before 2000, which is just before the tech crash, they actually increased the rates quite quickly. It's quite steep, as you can see. And then what proceeded was actually a big crash. Same with in 2005, the rate hikes went up so much. Then we all know what happened in 2008. So now we are seeing a situation where the hikes are also quite steep. Is this proof that, you know, something bad's going to happen? I don't know. I think we need to look at other things, right, in conjunction with what the Federal Reserve has done in response to issues and potential recessions. So does this mean that the tides are changing, right? Does it mean that now tech is back, essentially? Now, one thing I like to look at is the Purchasing Managers Index. The Purchasing Managers Index is essentially, without going into too much details, it's a leading indicator of whether the economy is growing or contracting, right? So what they do is they just interview a bunch of CEOs and business owners within the industry and get a sense of their mood, right? Are new orders coming in? How is their inventory like? Are they employing more people? So they add all this together and then mash it up and call it the Purchasing Managers Index or the Manufacturing Index. So it's manufacturing based, and actually it has 85% correlation with the US GDP, meaning that 85% of the time, if the PMI goes up or it goes down, the GDP will also go up and go down. So it's actually a very accurate indicator. Now, in terms of technicals aside, if it's above 50, then it's in a growing phase, and if it's below 50, it is contracting. So as we can see, typically the PMI has like a 6 to 12 months head start of the actual economy, because again, the people that are causing the economy to grow are the business owners, right, by and large. So they have a 6 to 12 months head start. And you can see very clearly, right, the number actually start to peak, right? The PMI started to peak at 60 odd in the first quarter of 2021. And it is 6 months later during, let's say, November or December, give or take, where the entire economy start to tank. So you can see it's quite an accurate indicator. And what it's showing me right now is that, generally speaking, not just tech, the economy is slowing down. But the growth is slowing, but it's still growing, right? So it doesn't mean that we are headed for a recession and all that, but it does mean we need to be a bit more cautious right now. So if you look at semiconductor sales, which is very linked to what we do in Malaysia as well, the numbers are also declining. It's still growing, but the growth is slowing. So again, it's all about nuance, right? There's no guaranteed recession. There's no guaranteed that rebound or anything. You have to look at the numbers in many different aspects. And I would say very interestingly that the valuations hasn't actually dropped that much. So if you look at the 2022 or 2021 peak, right, it was about 30 times earnings for the Nasdaq. Today is at slightly touching 27. So it seems like the market has been quite rational about this tech sell-off right now. But it has obviously gotten just a little bit more attractive as an investment. Now in the next segment, we'll talk a lot more about Malaysia. Alright guys, enjoying the video so far. If you are, please remember to give us a like, leave us a comment telling us what you think, and of course subscribe and click on the notification bell so that whenever new videos pop, you know it straight away. Alright guys, so now that's all like US, Nasdaq and all that. You want to know also what's happening with Malaysia a little bit more specifically. So now one thing that I like to look at is actually real semiconductor imports, which you can actually find in DOSM or e-statistic. This is something that Malaysia actually publishes. The Malaysian Statistic Department actually publishes every month. And it's actually somewhat of a leading indicator. Think of it like the PMI, but for the semiconductor industry in Malaysia. Now the logic is like that, right? If business owners see that the market is really good and their customers are hungry and the demand is there, what are they going to do? They're going to start ordering smaller, lower value semiconductors so that they can create higher value semiconductors for their clients, right? That's how the basic supply chain works. So that's really what this is somewhat of an indicator. So you can see, right, from June 2021 to May 2022, which is what you can see in the chart on this table here, right? It has negative growth out of 12 months, right? 6 out of 12. Now, the interesting thing is that I didn't put the data here, but if you actually go back, what you'll see is that from June 2020 to June 2021, that number was only 3 times negative. And the average contraction is minus 0.23%, whereas the average contraction for the latest 6 months is negative 0.33%. And so you can see quite clearly, right, in a growth phase or when the contractions are not as often, you can see the market doing a lot better. And once it starts contracting, then the tech index starts to fall. So again, this is one of my favorite indicators to look at to see whether or not it is the right time essentially to get into the tech sector. Of course, it would be good if you can go back even further, right? If you want to see, let's say, from May 2020 to June 2020, let's say June 2020 to May 2021, you want to look at the previous 12 months as well and see what was that like, so that you can get a clearer sense of where the market's heading. But yeah, feel free to check this out. Go on DOSM. Unfortunately, the way they present the data right now is still a bit raw, so you're gonna have to use Excel and a lot of typing out, but it is what it is. So That's less like big picture, but how about the hints that we are getting from some of the quote unquote semiconductor companies, or rather not to say semiconductor, or at least companies linked to the semiconductor manufacturing sector, linked to chips, linked to integrated circuits and all that. So here you have MeTech. So here are some of the highlights. As you can see, there's a slowdown in smartphone and mobile device industry, which they are linked to. And of course, they sense that the demand is actually a lot weaker, or at least they're explaining their numbers that the demand is actually weaker. However, they are still planning some sort of expansion, right, at third business unit. So that's something quite positive. But they end by saying, essentially, especially in the short term, they do expect their profit margins to be essentially lower. So how about Vitrox, right? The big guy in the what's the word? They sell machines to test the vision inspections for various devices, and you can see they're saying the same thing, right? The demand, right, the lower sales is actually happening to them as well. And whenever they get an increase, right, in profit or profit before tax, it's because of the strengthening of the US dollar, not because of something business related. So Unisem, again, they also had improved gross margins, which they explained to the USD MYR exchange rate. So again, it's not as entirely business related. Gtronic, again, forex gain, right? So they're not giving us hints, right, about the demand, right? Or if they do, it's generally, it's generally a downer. And then the last bit is that Frontcan is the only company right now that are saying that actually they're getting a lot of demand for their products. So we did a video here, you can go check it out. But essentially, Frontcan is in a very unique position. They're more of a service-based rather than a manufacturing kind of company, and that makes them very unique in the space. We won't go into depth, of course, but it is what it is. So in summary, I think the first things is that I do believe that the slowdown kind of makes sense, because the slowdown of the rate hikes makes sense because the PMI is dropping, right? When the PMI is dropping, that's when that the economy does not have as much steam as it used to be. So when it already does not have much steam, imagine if you were increasing interest rates, right? That will put speed bumps into the economy. Now the second thing is that even if a lot of people are saying because they lower the Fed funds rate or the interest rates, therefore tech stocks will do well. But if the Fed funds rate do not drop to a level where they can manage a potential recession, which is what the PMI seems to be heading there towards, then it doesn't really matter even if interest rates are low, because then every stock, including tech stocks, will tank, right? Now, again, the whole semiconductor, which is not entirely tech, but it's, let's call it physical tech, it's dropping in sales. Again, this doesn't mean that, it's going to go all the way down, but it just means that you need to be a little bit more cautious. Now, just as the market has been quite cautious. As far as leading indicators, the real imports of semiconductors for Malaysia, you can see that the situation is getting a little bit worse. The business owners are less bullish about the growth of their semiconductors and their businesses. And when we look on the ground, when we look at what the different companies are saying, it's somewhat of a verification of all this macro data. So those are my thoughts. And guys, if you find this video very useful, or if you know someone who might find this video very useful, remember to share it with them. Follow us on our socials like Instagram and Facebook. And we also have a Telegram chat where you can get updates. And I will see you in the next video.